Hello guys, welcome back to the channel. Today is the 1st of February 2017. So this is going to be a continuation from my part 1 video titled Warning, do not buy a home or pay a mortgage in 2017 to 2018. So I'm probably going to have to record this in a couple of sections due to the research involved, and that quite likely I'm going to have to create a chart because I'm unable to find what it is that I'm looking for. So the basic layout around this part 2 is going to be talking about the added benefit of not just waiting for a market reset to occur, but to making proactive moves into various other forms of asset prior to the paper market changing, and the asset class that we're going to be targeting in order to maximize our purchasing power come time of market instability, which ultimately leads to trillions and trillions of global currencies being wiped off the stock markets, bail-ins occurring to support the failing banking sectors, which ultimately leads to large levels of foreclosures. So the commodity that we can maximize our current levels of fiat currencies is, as per the channel's name, silver. Now the majority of my subscribers will understand what silver is all about and why we have to be holding it during this transitional phase, this transfer of wealth, which will be occurring during the next few years, maybe earlier on in that cycle or maybe later on. Nonetheless, inevitability is these events will happen. You just have to position yourself in accordance to profit from this when the event goes down. Now, for people who aren't aware of what silver is and why it is the most important hedge, I suggest that you pause this video and you go and get some information around the ratios of gold to silver, the patterns it has done over time during market instabilities, recessions, crashes, and that could take several hours of study. Other people have spent lifetimes studying it. But this is the most important financial lesson of your life. And if you're fortunate enough to be watching this video now, you stand an amazing opportunity at protecting and gaining vast amounts of security for your future. And again, for those of you not up to speed with what silver is about, things you need to stick into a search bar is silver manipulation, silver production and consumption, how much silver is available in bar and coin form for purchase per year, how much of the population invest in precious metals, and what the populations are of countries, to give you an indication of how minute the current levels of investment are and how short the supplies that stand for physical delivery are. And that's something you also have to research is the deliverable silver. It isn't the COMEX paper traded versions, because that does not stand for delivery. So I'll leave that there, guys, and get straight into this part 2. So inside of this video, there's going to be quite a lot of charts that I'm going to be showing you, all in order to give you the understanding of what the potential swings and movements are during past times, current times, and verbally on future times. Because everything in life is a cycle. Things do not go up forever. We just hope that these cycles reset, obviously during our lifetimes. But that is all down to the manipulation. How long can the game of manipulation last? How long will people trust the fiat systems, that are devouring their purchasing powers on a daily basis. And if you haven't noticed, the rate at which currencies are fighting each other, depreciating, devaluing, and we're talking 10% a year, 20% a year, while the petrodollar is rising. This system collapses. That's a given. So now that we know that, and from the previous video, we have a great understanding of where the property value should be heading. Where do we project the silver market is going to be heading? So let's start with a few charts, just to make it fresh in our minds of what's occurred during history. And the information held within this video is the sort of topic that I believe should be taught at a fundamental age. But because this is the secret of money, this is real money, precious metals, which has been money for 5,000 years. It works, but as with everything, it always gets diluted. It always gets manipulated, which is why it always fails. So the information that's going to be inside of this video is the sort of stuff that I think only the elites are taught about understanding what is money, understanding what is markets, and understanding how to flow through the markets to maximize one's wealth, to maximize your purchasing power, and to maximize the generational security of your family. So let's get straight into the charts to study what is occurring, what has occurred, and what will occur. So the first thing we have to understand is that at this juncture, in currencies, in debt, in system cycles, the extreme levels we are facing are totally unprecedented. The perceived invention of the debt inside of the global systems currently have never been so astronomically high in comparison to life for the average person. The markets, the bonds, the derivatives have been pumped up so high. There's no comparison in history to these levels of bubbles. So understanding that, we understand that the anticipation is when a reset or explosion occurs inside of the never before in history has this happened explosion, we have to anticipate the most volatile move, unimaginable inside of the precious metals markets, inside of the alternative safe haven asset classes. Because no amount of fiat currency flooding out from the implosion daisy chain markets is going to be enough for people, intelligent people, to sell their real hard assets like silver. Not to mention, there won't even be time for hedge funds with billions of dollars or pounds or euros to rescue it. It will be swallowed into a black hole of debt destruction. Alternatively, in order to facilitate this debt, it has to be backed by a commodity, and the natural commodity would be gold. Hence why all the global banks and elites are hoarding gold as fast as they can acquire it. However, silver is an even smaller, minute asset class, where something like only 1 billion ounces are produced. The majority of that is consumed by industry, etc., which leaves a very small amount for investment terms, which is why the banks and the elites don't hoard it, because the vast inflated availability of fiat currencies that they have would be enough for just 1 or 2 individuals to purchase the entire global supply, which would have what impact on the price? It would rocket up in price, and the whole game would come crashing down. Because in order to control the fiat currency markets, the precious metals have to be manipulated low. It's the barometer of value. It's the barometer of the US dollar, the petrodollar. So the only time metals will increase drastically in value, and we're talking multiples, is when the system is up, is when it's time for that transition phase. Everything else that happens in between that is irrelevant because it's still controlled. Okay guys, so I'm going to start to build the data up and present it to you with the reasons behind why I think things are going to go a certain way. And it's amazing, especially here in the UK, I'm not sure about the rest of the world, but people's favourite pastime, when they nip down the shops for that pint of milk and they walk past that estate agent window, they love to have a good look at what's going on in the area. It gives them that comparison factor and how well they think they might be doing in their particular circumstance where they live, their homes. But I wonder how many of them actually review it the way we're about to. So I'm going to start this with the mortgage approvals from 1993 through to 2011 to give you a rough indication of the patterns that are occurring in, say, the last 25 years on the UK housing market. Now, I would have loved to have made every single chart customized to what it is that I want to portray and show, but the time involved with that sort of work will take weeks. So we're just going to have to use what I can find and link it in to more recent data coming up shortly. So we can see the red line is representing nationwide historical house prices from 1993 into 2011. And we can see the monthly number of mortgage approvals, the green line representing seasonally adjusted and the blue representing not seasonally adjusted. So we will take the olive green line for seasonally adjusted. And this is all to build a background knowledge because it will be used later. So we start in 1993 in the range of 80,000 mortgage approvals, when the average price of the home is in the region of about £50,000. If we jump forward 10 years to 2003, we are at 100,000 mortgage approvals, with the average home price being 110,000. So it's doubled in a 10-year space. And if we now take the last projection of 2011 on this chart, the mortgage approval rate after the 2008 crisis that we're all aware of, I'm not going to go into, slashed those approval ratings due to new banking legislation supposedly to clean up the lending procedure, making it more difficult and making it more accountable for people producing their income slips to prove that they can obviously afford the sums and the repayments required. And the approval rates dropped to about the 40,000 mark, which is obviously a massive reduction. All the while, the property of the home was still floating around the £170,000 mark. So even though the property price has continued on the gradual rise throughout this 25-year period, the banks have had to tighten their lending in the last 6 years. So when we flip over to this next chart, which is representing the average mortgage rate from 1854 through to 2014. So if you've noticed, before World War I, it seemed to fluctuate between the 8 and 3%, with an average median around the 5. And in the last few years, it shot up to 15%, right down to 0, being the bank base rate. So what does this do? So this is obviously the repayment loan that people have to make. So if you borrow 100,000 and you have a 5% charge, your repayments and your living style is accounted for that level. But when you have wild swings inside of a repayment basis, that can be the difference between being able to pay it back and not being able to pay it back. So if we zoom in on that chart and check out the Bank of England's base rate between 1985 and 2015, we can see the extremely turbulent time of a 15% base rate in the 1990 period, dropping down to today's base rate of 0.5. So this effectively makes it much easier for banks to loan vast sums of fiat currencies for people to buy homes, for people to get on the property ladder, for people to upgrade from a 2-bedroom house to a 5-bedroom house via remortgaging, taking on more debt, having the impression of wealth. But you have to ask yourself, if you're getting used to lower and lower interest rates during the last 15 years, say for instance in 2000 you bought a home for 100,000 say, and you're set in the region of 6%, that means you are paying back £6,000 a year just to cover the interest, not the principal, just the interest. And the banks during 2007, 2008 had a huge systemic crisis. And how do they deal with propping up the housing markets? Well, they make it dirt cheap to borrow currencies to facilitate the artificial effect of wealth creation. So you got to ask yourself, in the next 10 years, where can they exactly go lower than zero to facilitate the artificial impression of a housing boom? And this chart here is the UK housing market, average UK house price. As of 2015, just shy of 200,000 UK pounds. And you can see from 1985 just how in a 30-year period it has spiked to what the majority of people call unattainable. And this actually does have knock-on effects later on inside of a society. So this level of debt from the £50,000 per house up to 200,000 was facilitated purely by governmental stimulus and money creation, creating what is known as an artificial bubble. And although the numbers have risen and people have the perception of wealth, wealth can be given and wealth can be taken. It all depends where you are in this system, because as we know, this whole region through here was known as the baby boomers era. And if you do a bit of background research into demographics, you will understand that that is now a phase that is passing, being followed by a less prosperous generation. Less jobs are available, higher debts are being associated to those uni graduates, and companies are generally laying off staff, not employing them. So what was once a philosophy in the period between 1985 to 2000 no longer is applicable in 2015, because it's the end of this cycle. This is the peak which has been squeezed out and has nothing much left to give. And the reasons for that are simple. So take a moment and pause this if you have to. But this is an exact definition of how a bull and bear market works in a cycle. This is a typical stock, bond and housing cycle, and you'll actually see the relevance to this very shortly. So I'll just hit a few points. You start off with the initial influx of capital. You then have a sell-off where people take their gains and a small amount of capital is lost inside of that market, followed by the institutional investments buying up on the dip because they saw the rally occurring. They then sell that rally off to the public, who buy it all the way to the tip, where there is then a classification of a new paradigm. But the market drops, and people have denial inside of the drop in valuation, thinking it's just a blip, it will recover. Sometimes it does recover momentarily, and people regain their confidence. But this is called a bull trap, followed by a severe revaluation that takes place, where despair happens through the whole journey down. And the level at what it hits at the end of its cycle is always just below the point where it takes off. and then the whole cycle starts all over again. This central section here is classed as the mania phase, and that's exactly where we are. But the unfortunate thing is, people are in denial and people are oblivious to this fact. And that is the majority of the baby boomer era that think on the long run, prices will just continue, not understanding that everything in life is a cycle. So as you will see, when we blend the two markets together, we can see the first bear trap sell-off phase followed with the high. So if we take a look at this chart, we can see exactly the same lines coming through with this bear trap section where people take their profits, followed by the institutional investment, followed by the public rush. We then have the 2007 crash, like this one, followed by a rally, which is a bear trap section, giving that false sense of piling in money back into that market with the belief that the markets are going to retrace back to higher highs. But what's the thing about higher highs? Well, you always get lower lows. But just because on this diagram, the return to normal point is lower than on today's chart, what hasn't been taken into account on the diagram, just laying out the principles of what this market does, it doesn't take into account the trillions that have been pumped into quantitative easing to prop up the banking sectors and to stimulate the housing markets, first-time buyer platforms, and all the different programs governments come out with to stimulate the purchasing of homes. So this is the most recent up-to-date chart that I could find regarding the UK housing from 2005 to 2016. And obviously this is the crash period, which when we revert back to the original longer time scale was quite a minor blip on the actual overall growth inside of that housing sector. And as I've said, this is the rally, which is a false rally before a sharp decline, reverting back to the mean. And that's quite a hard thing to actually logically understand, because you think, well, how can all this financial growth be lost? How can a house be worth 100 and tomorrow be worth 50? Because there's too much demand and not enough supply. Well, there's only not enough supply while there is demand. If you shake the world upside down and create huge turmoil, like what has happened for generations, like what has happened for decades, like what has happened for millennium, every single civilization goes through phases of collapse. It's a natural cycle. Now, does this mean it's the end of the world? No, it doesn't. It's just a financial market, which is nothing more than ones and zeros. And that's where people don't have the ability to break free from the shackles of the perception of wealth. Wealth shouldn't be seen as ones and zeros on a computer screen. Wealth is something totally different, but that's another video altogether. So we're now currently floating, I believe, around the £220,000 mark per the average home. All-time highs. Moving to the next chart. This is showing the home ownership rate from 2008 inside the UK to 2016 on a decline. And I believe this is percentage of population. So we're starting with a 73.3% of the population in 2008. And currently it's in the region of probably 63% of the population has what they call their own home. Now on this image here, there's a lot of information, but I want to hit on just a couple of points here, which I haven't been able to fully vet and verify, but to me the figure looks wrong. But nonetheless, hopefully someone out there can correct this. But the UK mortgage market as of 2015 represented 11 million mortgaged properties. Of that 11 million, 83.4% are home owners, private individuals taking out mortgages. And 16.6% are buy-to-lets, whether it be institutional investors or private buy-to-lets. From 2014 to 2015, there was an 8% increase in borrowed pounds, which is being estimated at £220 billion. And this is the bit that I don't quite trust. Total mortgage debt is £1.3 trillion. And if you could only imagine the amount banks are making off of this interest alone, providing that 1.3 is even correct. It also states on this that the lowest rate of difficulty since 2004, and this is obviously due to the financial crisis in 2008, but it states 10,200 homes were taken into possession as collateral for bad loans. This equates for 0.03% of all loans and 0.19% of all loans in 2014, implying the collateral has paid off some of the loan through the repossession orders. And it also states 100,000 mortgages, which equates to 2.5%, are in arrears, meaning they're unable to pay for their mortgages. So that's 100,000 homes where people are struggling to pay. And with a rough gauge, we would say there's 4 people per home. So that's getting on for 500,000 people that might find themselves in quite a tricky situation should the economy or should their jobs and should the state not be willing to support them. So we'll leave that chart there. Obviously you can pause it and read other sections inside of here, but we'll move on to the next one. And this is why I have a bit of difficulty in believing the figures in the last image, but this is such a hard number to find, and you guys have to understand that I've spent a lot of time researching and finding these images, which are thin and far between, and again is very hard to verify, especially with the sources where these come from, normally governmental agencies, and we all know the numbers are fixed. Anyway, this image of outstanding mortgages of homeowners in the UK, and I'm just going to take the blue line, as of 2013 and into 2014, is floating around the £10 trillion mark. So that's substantially higher than the previous chart. But obviously, guys, this is all just numbers. But what I'm trying to show is the grand scheme of debt inside of this market system. And this is only representing the housing sector. And a lot of these housing sector bank loans are actually sold off from the banks to third-party derivative packages, all in a daisy chain of offsetting and balancing and repackaging and balancing and selling it off to somebody else, creating vast spider webs of extremely complicated debt in the trillions. So this is the best indication I can get towards homes in the UK. The Department for Communities and Local Government dwelling stock estimates as of 2015 in England. There were 23.5 million dwellings in England at the 31st of March 2015, an increase of 171,000 dwellings on the same point the previous year. 14.7 million homes were owner-occupied dwellings. And guys, of which we know 11 million have a mortgage, which means 3.7 are not mortgaged and are owned outright. But it also states 4.7 million private rented dwellings. So they might represent the buy-to-let of large institutions and privately wealthy people. And 4 million social and affordable rented dwellings, private registered providers, plus local authority like council estates and places for immigration. So I'm sure somebody out there who is exceptional with maths will be able to crunch all the numbers for me to verify whether these figures were correct. because for me there's just way too many zeros to even get my head around. So I found this chart, which gives us another insight into the US mortgage debt outstanding. And this shows the table of growth from 2001 to 2015 in trillions of US dollars. And this is courtesy of the Federal Reserve. In 2001, 7.5 trillion in debt. Today, it is 13.8 trillion. So it's effectively doubled in a 15-year period. So whether these figures are correct, again, the Federal Reserve, I doubt it very much. But even if it's a 1.3 trillion debt in the UK, add that to the American system, and that is already a total plus minus 15 trillion US dollars. Or at the upper end, if it was 10 trillion in the UK, you're now pushing close to 25, 26 trillion dollars of debt, which has been generated out of nothing, out of thin air. And who is responsible? And where does all this trillions go? Well, it all funnels back into the underwriters and the few people that hold this debt as collateral. And these people have 100% authority to take full ownership of anybody's home if the terms are not met on the agreement, i.e. you fail to pay. So what can we understand? So we're in a hyper bubble inflated scenario. We have the banks flooding the markets with debt. We have people soaking up that debt and wanting more. They can't get enough of these inflated house prices. They see it continuing to rise and the debt continuing to grow. And I'm sure the bankers are loving it. But the problem with complex derivative chains is there's always a winner and a loser. And these are constant bets being leveraged and leveraged against, adding more and more strain into the system, because ultimately it is creating a hyperinflation, because you can see that in the property prices. And that's all good and well for the people that hold homes. But there comes a time where it snaps. Because do you think it's in the interests of the bankers to have those loans repaid? Or do you think it's in the interest of those bankers to gain 100% collateral for all your hard work over the years for paying off that mortgage and getting close to paying off that mortgage? As we know, all the baby boomers have worked their entire generation riding this property wave to possibly have the whole 60 years of their life's work ripped from them if this market tanks and reverts back to mean. It's an if, guys, because there's no guarantees in anything. This hyperinflation could continue to the average price of a house being 10 trillion. There's nothing stopping the printing and creation of credit. It comes down to the people's ability to sustain life inside of its cycle. And that can't be done when everything gets super inflated in prices, because the wages don't maintain a level playing field, making everything over time become unattainable. What does that do inadvertently to the demand? The demand drops unless only a few are acquiring, and only a rental market which has been bought up by the corporations is available. And then the markets in a rental scenario would be at saturation point of the highest possible prices that can be achieved by the corporations before the system doesn't work. And this all reverts back to an unbacked, unlogical fiat global currency for every nation. No nation in the world is backed by anything. So they can print a trillion of your currency, and the only effect that has is it depreciates the little man's purchasing power. Because the people at the top of the food chain who are creating this and putting it into the markets are benefiting because they are at the first stages of injecting this into the economies. We are at the bottom of that cycle, so it affects us the most. So we'll move on. So this is Japanese house prices, and this is for anybody who thinks housing prices can't come down. They always regain. Well, they do to a degree because it's a cycle. But this is evident proof that when a government prints trillions, for example, yen, it saturated the housing market. And over in Japan, no longer is it a one generational mortgage. It's like a 10 or a 20 generation mortgage. So you take out a mortgage and your children's times 17 more times will be the last ones to pay it back. And that has obviously stopped their housing market dead in its tracks because it's unattainable. So you either live with your parents for generations and never actually even get out to have your own families, which then creates another video altogether regarding the social impact and what that does to the next of kin, again falling into the demographic situation throughout the decades. But the point of this slide is to show how for 15 years house prices in Japan have been on a fall from 1992 to 2005 and are only slowly starting to come out now. And for people who just think, well, yeah, that's Japan, I'm in the UK, I'm in America, I'm in Europe, it makes no odds. Your governments are printing to oblivion, and that will be the effect if it carries on. Generational family homes, because nothing else is attainable. So I found this repossession statistics from 1969 to 2016, and this is the UK. Now I'm not going to read them all out, I'm just going to go for example down here from the 2000 period up into the crash. So we can see the crash starting to happen here in the 2007-2008, and it was immediately hit by 40,000 repossessions. Banks taking over people's homes because they couldn't afford to repay, because they lost their jobs, because they stretched themselves too fine on the repayments. They didn't have enough income to cover job losses. And for a few years, the average roughly for 5 years is 40,000 people a year, even after the quote recovery happened. There's still a couple of 100,000 repossessions here. Call it 300,000 homes that banks have taken. People's deposits and potentially decades of paying in to that loan have been lost. And what have you gained from that cycle? These people have had their homes, they might have had multi-decades of paying into the system, and then they found themselves washed up on the street with not a penny, with a family, and with no job. Plus they've just lost however many years that they spent trying to gain that, trying to build something for their future. Taken because of an artificial currency boom that was created, and then subsequently a crash. But as we know, the banks had the great plan of this will never happen again. We're going to tighten lending. We're going to do this. We're going to do that. And numbers, you will see, have started to drop down as the economy, quote, improves. There are still people throughout this entire cycle, through here, this period, this last 30-year period, that might have only just scraped by until new jobs were created. And effectively, we could, if a serious 1930s impact hits, which many predict, it will be way worse. And that's what I'm trying to show you, is it will be way worse than 1930. This is going to be the biggest financial explosion, which is going to send hundreds of thousands of people out of their homes, maybe even millions. And who gains those properties? Who gains all that money that was paid into the system? The banks. Whoever owns that collateral takes it. And these people have worked their lives and had it stolen from them. That's the reality of what's going to occur. And these numbers represent a family of 4. So you can times all this by 4. And that should actually sink in and bring a bit of reality to what the actual damage an unbacked currency does. And people don't get that. People will literally kill themselves because of the transfer of ones and zeros on a screen. And the bankers will laugh at that. Weak, pathetic people. So that's what I'm doing, guys. I'm making you not weak. I'm going to be making you strong. And you will be able to protect yourself, and you will be able to gain from what they're trying to do to you. I see it, and I will share it.